Hello and welcome. My name is Austin if you're new here, and I'm a certified financial planner practitioner. On this channel, we help educate you on complex financial planning topics. If you like this video, give it a thumbs up and subscribe to our channel for more helpful content. Today, we're going to be talking about the benefits of staying the course during turbulent times. So when markets become volatile, investors sometimes wonder if they should pull their investments out during the turbulence and then get back in when the volatility cools off. But I want to share with you some data that could make you change your mind about this type of strategy. And this is based on some Vanguard research from back in June of 2022. And this suggests that the best and worst trading days tend to happen closely together. And we can see this based on this period of time between 1980 and 2020, that of the 20 best trading days during this time, 9 of them occurred in years where the annual return ended up being negative for that year. And 20 of the worst trading days during this period of time, it shows that 11 of those 20 occurred in years where there's actually a positive total return for that year. So let's keep this in mind as we go forward here. This chart shows the markets from 1928 until 2021. So during this 93-year period, if you had been invested in the S&P all 93 of those years, you could have expected about a 6% return if you'd stay invested the whole time. However, if you had missed just the 30 best days out of that 93 years, you can see down here your return would have been almost half, about 3%. So this is kind of represented differently here on this bar down here at the bottom. This bar represents 23,000 plus trading days during this 93-year period. And this tiny bar at the end with the arrow pointing to it represents just the 30 best days. Okay, so if we keep in mind that the best and worst trading days tend to happen closely together, then if we are inclined to shift our portfolio or move out of the market during difficult times, we may be missing out on some of the best trading days that help recoup losses in our portfolio. Let's look at a practical example here. So this shows the growth of a $100,000 portfolio invested in a 60-40 asset mix from January of 2017 to May of 2022. And it shows a couple of different times when the market had some drops. This was back in January of 2018. This was back in December of 2018. And then, of course, this here is the pandemic, March of 2020, and it showed the market dropping here. Now, the orange line just shows the 60-40 portfolio growing as if you had just been invested the entire time. And it shows, let's call it, it gets to about $145,000 during that period of time. If, however, the yellow line shows if you had moved 100% of your portfolio to cash for 90 days and then reinvested it in a 60-40, and the green line is showing just moving the stocks to cash and then reinvesting after 90 days. But you can see here the deviation that occurs. It's most noticeable here in December of 2018. You stay out of the market for 3 months and get back in. You can kind of see the difference here. And then again during the pandemic, you get out again, and now there's a pretty big difference. And it ends up with a difference of wealth of about $31,000 on your initial $100,000 investment. So this is just, I think, gives some perspective to the idea of, hey, I'm just going to hold my money on the sidelines or wait out this turbulence and then get back in when things cool off, as we may be missing out on some important recovery times. And Peter Lynch is one of the most successful investors and the former manager of the Magellan Fund at Fidelity. And he said that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And I certainly think this is true. And as a financial advisor, it's common that we may recommend small tweaks or adjustments to the portfolio or to even rebalance during turbulent times. But during volatility, abandoning your financial plan altogether contradicts the benefit of creating the plan in the first place. So as an advisor, we can help act as a sounding board and help provide behavioral coaching to direct you through those difficult times and help you maintain the focus on what's most important. Thank you for watching. If you have questions about what you've learned, click the link in the description to learn more about our firm and how we can help.